Today's mortgage definition is bankruptcy. So, what is it? Defined bankruptcy is a legal process where individuals or businesses unable to repay debts can seek relief through the courts. Now, how does it apply to the mortgage industry? Well, since it's a major event that affects credit, it can impact a borrower's ability to qualify for a home loan, but not necessarily forever. Depends on the time frame. As you may have heard, there's different kinds of bankruptcies, and you've heard of the different chapters, like it's a book, right? Now, I'm not going to go into all the details of each one, and we won't go into chapter 11 as it typically applies to businesses. So, the two that we're going to deal with here are chapter 7 and chapter 13. Now, with chapter 7, you're dealing with a discharge or the elimination of debt. With this one, it stays in your credit typically for 10 years. With chapter 13, you're dealing with a repayment plan and it would stay in your credit for 7 years. Now, you hear those numbers 7 and 10, and you're thinking, how am I ever going to get into a home if you're in one of these situations? Well, it doesn't really work that way. Different loan programs have different time frames before you can actually get a mortgage. And if you have specific questions on each one, hit me up. But with conventional, it's typically a 2 to 4 year wait, depending on which kind. With FHA and VA, it's at least two with Chapter 7, but it can be sooner with 13. With USDA, it's typically 3 years with some leeway for the 13s. So if you happen to be in one of these situations, don't lose hope. Bankruptcy can delay home ownership, but it doesn't eliminate the possibility. And as always, talk to a pro to work out a game plan if need be. Have a great weekend.